Now we will learn about the cash flow hedging. So companies use cash flow hedges to hedge exposures to cash flow risk, which results from the variability in cash flows. Now, when company signs any contract into cash flow hedge, the company must need to report it on the balance sheet, and the company also need to report any gain or losses related to that cash flow hedge. Now remember, previously we have seen that for derivatives, call option example, and fair value hedging, when the company has any unrealized holding gain or loss, they reported it in their income statement. But for cash flow hedge, if they have any gain or loss, they will report it under the stockholders equity part as other comprehensive income. So unrealized holding gain or loss from the cash flow hedging will be on their balance sheet in the stockholders equity part. Now we will see one example of cash flow hedging. Allied can company, they manufactures can and their raw materials is aluminum. So in September 2025, they expect that they have to purchase some aluminum in January 2026. Now aluminum price may go up or down, but they don't want to face the fluctuations risk, and that's why they entered into a future contract. And the future contract gives the right the company to purchase 1000 metric ton of aluminum. Per ton is 1550. Remember, options are the rights to purchase. On the other hand, forward and futures are an obligations to purchase. So for stocks we call it forwards, for commodities we call it futures. So if you are into any future contract, you must have to purchase those. So they enter into the future contract. Now they are obligated to purchase 1000 metric ton aluminum for 1550. Now the company is kind of relieved. No matter what the aluminum price is, they know they locked into a fixed price and they don't need to face any variability. So now here the contract will expire in January 2026, and we assume that when they sign the contract on September 1st, the aluminum spot price and the contract price both are the same. So basically there is no value at that point, so they will not do any journal entry on September 1st. But what happened here at the end of the year, December 31st, they close their financial statement and they will check whether they are making any gain or losses from those futures, and they found that the aluminum price increased to 1575 per metric ton. So now, although they are not purchasing any aluminum at this point, they will do it in January, but depending on the price change, they will calculate gain or losses. So they can purchase the aluminum for 1550, but aluminum price went up by $25, 1575. So basically they are making a gain having those future contracts. So they will credit unrealized holding gain. Remember, this gain will be a part of the stockholders equity part, other comprehensive income, not an income statement item, rather the balance sheet item. So from each ton aluminum they are making $25 and they have the right to buy 1000 ton. So they will multiply it by 1000, and at the same time futures value is also increasing, so they will debit future contracts 25,000 and they will credit unrealized holding gain or loss, and they labeled it equity because it will go to your stockholders equity part. That's year-end journal entry. Now what happened in January 2026? They need to manufacture those cans and they purchased 1,000 metric ton aluminum for 1570 from the outside market. That's the current market price. So they will debit aluminum inventory, they'll credit cash. Well, they're purchasing from the aluminum market, they paid spot rate today or the current market price. But now you remember they purchased that future contract they already have, and because of that, when they will settle that future contract, they will receive $25,000 cash. So from whom they purchase those future contracts, they are not physically purchasing, selling aluminums, but they will settle it based on the aluminum price. So here what they will do, they will receive cash, $25,000, they will debit cash, and based on the market price on that day, they will adjust this $25,000, reducing the future contract price. And then you will see how that future contracts helps them to protect the cash flow fluctuations, although they are paying actual cash $1,575,000, but from that settling that future contract, they received cash. So their hope was to lock into that fixed price. Their hope was that they don't need to pay any high or low, because based on the future contract price, they're supposed to pay $1,550. So that was their wish, and they actually did it. Although when they purchased from the market, they paid $1,575, but from settling that contract, they also received $25,000. So final cash payment is as what they wanted. This is how companies actually protect any cash flow fluctuations, by purchasing these future contracts. Now what happened? Several months passed, they used those aluminum, they produced cans, and they sold those cans. They sold those cans, and here they sold those in July 2026 for $2 million, and they also recorded the cost of those cans, $1.7 million. Of course, the aluminum cost plus few other costs they have to manufacture those cans. They recorded in July, they recorded the cash journal and sales journal entry, cash debit, and sales revenue credit. They also recorded the cost of goods sold. Now, one thing you have to remember, this cost of goods sold is based on the higher aluminum price, $1,575. So this cost of goods sold is actually overstated. So they will do one more journal entry to adjust this cost of goods sold. And you know what they will do? You remember they made unrealized gain or loss from that future contract. So they will use that gain to offset this increased cost of goods sold. So in July, they will offset these increased costs of goods sold, and they will eliminate these unrealized holding gain or losses, and then they will reduce the cost of goods sold. This is how actually the future contract helped them to reduce the negative or any fluctuations related to their cost or cash flows. You will learn some other concepts related to these derivatives, but here you don't have any accounting part, just some concepts. For example, hybrid securities. Companies may invest in hybrid securities. Means that these securities, they have both type of criteria, debt criteria and equity criteria. For example, convertible bond. Convertible bond is an example of hybrid security. So initially companies issue it as a bond, debt securities, and then later the bondholders have the right to convert it into equity. So convertible bond has both components, debt and equity. It's a common example of hybrid securities. So just for your learning purpose, be familiar with these terminologies. The debt security is here host security, and since they have the conversion options, that equity, which is refers as the embedded derivative. Now, for accounting purpose, when you have to record these embedded derivatives, the company needs to separate the host security from these embedded derivatives. They need to report it separately, debt and equity, and this process is known as bifurcation process. Now, when companies need to report these items on their financial statements, and especially for hedging, FASB says that you need to identify few more information, and you need to have proper documentations, risk management purpose, why you are doing this hedging, effectiveness of the hedging, for what item you are doing hedging, and what are the other related item or underlyings you are using for the hedging, what's the relationship, and then how this hedging will impact on your financial statement, especially for earnings, and how you are using those hedging to face the fluctuations either in changes in fair values or in cash flows.